Welcome back to the deep dive. Today we're looking at a really unique way to invest in biopharma. We're asking this fundamental question: why try to pick one winning drug when you could, effectively own the toll booth on the entire biotech highway?
It's the ultimate picks and shovels play for the pharmaceutical world, right? And we're going to focus this entire deep dive on one company, Royalty Pharma, ticker RPRX.
Okay, so what's our mission today?
Our mission is to really dissect their incredibly high-margin asset-light business model. Then we'll synthesize the proof points from their latest financials. The Q3 2025 results are exceptional. And then, most importantly, we have to explore the big debate.
The valuation debate.
Exactly. The whole conversation, really, it all hinges on what the market thinks about their terminal value.
That terminal value question is the real tension point, the thing that makes this company so fascinating to analyze. Let's just be clear about where they sit in the market. Royalty Pharma is, without a doubt, the largest global buyer and the main funder of biopharmaceutical IP streams.
And their core thesis isn't about the science, not really. It's not about clinical risk. It's about securing predictable, high-margin cash conversion.
And the numbers seem to back that up completely.
Oh, flawlessly. Our sources show a company projecting robust double-digit growth. We're talking 14 to 16% expected for the full year 2025 in what they call portfolio receipts,
While at the same time maintaining an incredible cash margin.
an exceptional portfolio cash flow margin, or PCF, of 81%.
81% cash margin. I mean, that figure's practically unheard of in any industry, really, let alone one that's even remotely connected to complex R&D.
It's staggering.
So here's the paradox we have to unpack for you. How can a financial powerhouse, a company generating cash with this level of stability and efficiency, be trading at such a profound discount compared to its peers on cash flow metrics?
That's the disconnect, a massive disconnect between the quality of the business and the valuation the market is giving it right now.
All right, let's get into it. To resolve that paradox, I think we have to start with the business model itself, the structural advantages.
Exactly. You have to understand that this isn't just a collection of assets. It's a proprietary platform.
Okay, let's unpack that. Royalty Pharma's function is, on the surface, almost elegantly simple. They just aggregate the rights to future income streams, royalties, from successful, already approved drugs.
That's the key. They aren't inventing them. They aren't running the sales teams.
No supply chains, none of that operational headache. They are pure financial engineering partners.
Exactly. Their critical role, their place in the whole life sciences ecosystem is as a non-dilutive capital provider.
And their partners can be anyone, right? From big pharma to university.
Anyone. A major pharma company looking to monetize a mature asset, a smaller biotech that needs funding for its next trial, or, even an academic institution that holds the original IP and needs a big upfront cash injection.
So RPRX comes in, buys that future royalty stream, let's say it's 10% of all future sales, and they give them the cash right now. Why is that so much better than just taking on debt or issuing more stock?
Well, it all comes down to control, speed, and strategic flexibility, right? If an innovator goes for equity financing, they dilute their own stake. They can lose control. They bring in new voices who might interfere.
Right, new board members they have to answer to.
And if they use traditional debt, it can be really restrictive, super costly, or, maybe just completely unavailable for something complex like funding a late-stage clinical trial. A bank might not want to lend $500 million against a phase 3 study.
But Royalty Pharma can. They know how to price that specific risk.
They do. So it really fills this strategic void. The innovator gets the immediate substantial funding they need, but they keep full operational control and the core IP. All the capital, none of the interference or the equity haircut.
One of the analyst reports we looked at really put it best.
Which one was that?
They called it an almost no-brainer choice for biopharma firms compared to the other options. It's just a clean, simple transaction that lets the scientists get back to science.
Right. And lets RPRX do what they do best, which is manage the financial side of waiting years for that income to roll in.
Okay, now let's talk about the competitive moat. This model sounds great, but how hard would it be for, say, a giant private equity firm to just swoop in and start copying it?
You'd think it would be easy, but it's incredibly difficult. And the main reason is the overwhelming scale RPRX has already built. Scale is everything here because it creates access.
They're the established leader.
The dominant leader.
Yeah.
They control a massive 53% market share in all of biopharma royalty financing.
And that number gets even crazier when you look at the really big deals, doesn't it?
It really does. When you narrow the focus to the deals that really move the needle, the ones over $500 million, their market share jumps to an astounding 77%. This kind of concentration gives them what our sources call preferential access. It's a rich pipeline of opportunities. If a major pharma company needs to offload a billion-dollar royalty stream, they go to the one firm that can write that check quickly and reliably. That's RPRX.
But size can't be everything. You have to have the expertise. I saw a number that was just mind-blowing. They have only around 35 employees and just 13 in R&D, and they're executing these massive global deals.
That's the expertise moat. It's critical. They're not just buying a simple income stream. They are pricing these enormously complex, highly technical assets.
So their internal due diligence has to be world-class.
It has to be. It demands this deep, comprehensive knowledge that cuts across like 4 different fields at once. You need to assess clinical trial risk, navigate incredibly intricate IP law, which changes by country, understand all the regulatory exclusivity pathways.
And on top of all that, be able to do long-term global sales forecasting for potential blockbusters. They have to be better at predicting the future of a drug than the company that made it.
In many ways, yes. And their operational structure lets them capitalize on this expertise with just incredible efficiency. We talked about the 81% cash margin, but look at the cost side.
The operating costs.
Their entire operating and professional costs are expected to consume only about 9 to 9.5% of their total portfolio receipts for the full year 2025.
Just 9% of revenue goes to running the entire company.
But that brings me back to the headcount. I mean, only 35 people. Does that introduce some kind of unforeseen risk? A bottleneck in due diligence quality, maybe, especially with how fast they're buying things?
It's a fair question, but the defense is that they are not a traditional company. They're a highly specialized financial platform. They don't need a huge bureaucracy because they're outsourcing all the hard parts, manufacturing, marketing, distribution. All that risk stays with the partner.
So their small team is just hyper-specialized.
Absolute experts, scientists, IP lawyers, financial modelers. The pre-IPO example is so powerful. They were generating over $1.8 billion in portfolio receipts with that tiny structure. The operational leverage is a feature, not a bug. Okay, so we see the efficiency, we see the market dominance. What about the runway for growth? How big is this market opportunity?
It's immense, and it's structurally resilient. I mean, life sciences innovation will always be capital intensive, right? The total addressable market, the TAM, for funding in this space is projected to be over $1 trillion in the next decade.
$1 trillion. But that's all funding.
Yeah.
Where does royalty financing fit in? Is the market already saturated with this kind of deal?
Not even close. That's the really exciting part. The penetration of royalty financing as a funding source is what one of our sources called outrageously underpenetrated.
How underpenetrated are we talking?
It's only about 3% of the total biotech funding mix right now. So that confirms there's this huge, vast, investable universe out there, and it gives them confidence in sustained growth that is, decoupled from the wider economic cycle.
In fact, a tough economy might even help them. If biotech equity markets get tight, the demand for this kind of non-dilutive capital probably goes up.
It does. They are not fighting for deals. The market is coming to them, and that market is growing.
And management is clearly seeing this. They're responding aggressively.
Absolutely. They've significantly increased their long-term capital deployment target. It's now between $10 and $12 billion over 5 years.
And that's way up from their IPO target, which was just over $7 billion.
Right. That increase, that commitment to spend up to $12 billion is a massive signal of conviction. They are seeing a continuous supply of high-quality, high-return assets that they believe they can underwrite profitably right now. The compounding engine has plenty of fuel.
Okay, let's move into that engine room then. Let's look at the Q3 2025 results. This is where you can really see the operational quality of the business in the numbers.
Q3 really did confirm that robust growth trajectory. Their top-line metric, portfolio receipts, hit $814 million. That's an 11% increase year over year.
And the vast majority of that is from the core predictable royalty payments.
Almost all of it. Core royalty receipts were $811 million, also up 11%.
So what were the key assets driving that double-digit growth?
There were a few really strong performers. Vornigo was a primary driver. Tremfya receipts were exceptional. They jumped a massive 44% year over year to $49 million.
44%. That's huge. That signals the partners having incredible success marketing that drug.
Tremendous success. And their flagship, the cystic fibrosis franchise, also continued its solid performance. It was up 7% to $222 million, still the bedrock of the whole portfolio.
And management was clearly happy with the results. They kept raising their full-year guidance throughout 2025.
They did, multiple times. The final full-year guidance for portfolio receipts was set in a range of $3.20 to $3.25 billion. That implies an expected year-over-year growth rate of 14 to 16%.
And the fact that they kept raising it suggests the new assets they've been buying are paying off even faster than they originally modeled.
That's exactly right. It speaks to the quality of their underwriting and due diligence.
Before we move on, we have to talk about 2024. Because if you just looked at that year, you'd see an 8% decrease in portfolio receipts, and you might see a red flag.
That requires some careful context, yeah. That decline was entirely an accounting artifact. It was not a sign of fundamental weakness at all.
So what happened?
It was due to a large, lumpy, one-time milestone payment, a $525 million payment related to Biohaven that they received in 2023.
So that skewed the comparison.
Hugely. If you pull out that kind of chunky, unpredictable income, the underlying core royalty receipts, the predictable cash engine, actually grew a very healthy 13% in 2024. The core business is accelerating.
Okay, that brings us to the most crucial and honestly the most confusing part of this story. Why the normal PE ratio is basically useless here and why we have to focus on PCF.
It is confusing, and it's because of these kind of archaic accounting rules that completely distort their true economic earnings, specifically a GAAP rule called ASC 83530.
Right. So in plain English, what does that rule do? It makes them report royalties as amortized cost financial assets. What does that mean?
Think of it like this. If RPRX buys a royalty for $1 billion that they expect to generate $1.5 billion over 15 years, GAAP forces them to treat that purchase like buying a bond or a building.
Meaning they have to depreciate it over time.
Exactly. Every single quarter, they have to deduct a non-cash amortization charge. It's basically depreciation for an intangible asset from their reported revenue. This charge is designed to reduce the book value of the asset over its expected life.
So even though they got the full cash royalty payment in their bank account, their reported GAAP earnings are artificially reduced by this huge non-cash expense.
Precisely. The result is that the reported PE multiple is completely obscured by these amortization charges. It tells you nothing about the actual disposable cash flow available to management. That's why we dismiss PE.
So we have to use their own non-GAAP metric.
We do. And that metric is portfolio cash flow, or PCF. It's calculated very cleanly. Adjusted EBITDA minus net interest paid, this is the number that truly matters.
Because it represents the actual cash left over for reinvestment, paying down debt, or shareholder returns.
And if we state that core efficiency metric one more time for emphasis,
Let's do it.
the Q3 2025 PCF was $657 million. And that results in that exceptional 81% PCF margin on portfolio receipts. That 81% is the number that proves the quality of the model.
Okay, so since they're generating so much cash, we have to look at how well they're putting it to work. Are they really compounding value?
Their efficiency metrics say they are. If you look at the last 12 months ending Q3 2025, their return on invested capital, or ROIC, was 15.7%, and their return on invested equity, or ROIE, was 22.9%.
And for the listener, just remind us of the difference there and why both numbers are important.
Sure. So ROIC measures the return on all the capital they deploy, both debt and equity. It shows how good they are at picking deals overall. And 15.7% is very, very strong.
And the ROIE.
The ROIE measures the return just on the shareholders' equity portion. And the fact that the ROIE at almost 23% is so much higher than the ROIC shows they're using leverage very effectively. They're borrowing money at a low cost and putting it into assets that generate returns far higher than that cost.
Classic financial engineering. So what about direct returns to shareholders? Dividends, buybacks?
They deliver a predictable dividend, about a 2.1 to 2.3% yield. But what's crucial is that it has an A+ safety rating.
Why so safe?
Because the payout ratio is incredibly conservative, only 19% compared to the sector median of 33%. They are clearly prioritizing reinvesting that cash into new high-return royalties, which is exactly what a high-growth platform should be doing.
And they're also buying back their own stock pretty aggressively.
Very aggressively. The strong PCF supports it. They repurchased 4 million shares in Q3 alone for $152 million. That brings the total for the first 9 months of 2025 to 35 million shares, or $1.2 billion.
Which signals management thinks the stock is a good use of capital, even with that huge $12 billion deployment target.
It does. They see it as cheap.
All right, but even a perfect toll booth can face, road closures or legal challenges. We have to look at the headwinds. What are the key concerns, especially that legal dispute?
The main headline risk right now is the Alyftrek royalty dispute with Vertex. This is a big deal because the cystic fibrosis franchise is RPRX's single largest cash generator.
And the dispute is material.
Very. RPRX firmly believes they are contractually owed an 8% royalty on Alyftrek sales, but Vertex only paid them about 4% in the quarter.
So about half of the expected royalty is being withheld. What's the core of the disagreement?
It's very technical. It hinges on the definition of the product in the original license. Specifically, it's about a component called deuterated ivacaftor. RPR says it's royalty-bearing under the contract. Vertex says it's a new, non-royalty-bearing composition.
And now it's in a formal dispute process. That's a huge legal risk for investors to watch. What about assets that are just naturally declining?
That's the constant churn of this model, right? Promacta is expected to see declines in the second half of 2025 because a generic version launched in May.
So even blockbuster drugs eventually face the patent cliff.
They do, and you see it elsewhere too. Imbruvica receipts were down 11% year over year in Q3. And we have to remember, the Entyvio royalty expired completely in 2024.
So the lesson is clear. That 81% margin is great, but it's meaningless without constant high-quality, high-velocity capital deployment to replace the assets that are naturally decaying.
Precisely. And that need for constant replacement brings us right to their acquisition strategy.
Right. Capital deployment for them isn't just for growth. It's a structural necessity just to maintain the value of the platform.
And they are executing that strategy with incredible aggression. They deployed $1 billion in Q3 2025 alone. That puts them on a strong path to hit that ambitious $10 to $12 billion target over the next 5 years.
When they're spending that fast, how do they balance the risk? Are they just buying sure-thing blockbusters, or are they taking some shots on pipeline drugs?
It's a very carefully balanced strategy. They blend the two. They deploy capital into immediate de-risked cash flow assets royalties on products that are already approved, and they mix that with high-potential pipeline assets.
Which they fund with those synthetic royalties.
Right, which are tied directly to specific clinical success milestones. So they're using the stable cash from approved drugs to underwrite these calculated venture capital style bets on late-stage candidates.
But with a much more informed scientific edge than a typical VC.
Exactly. And their recent acquisitions really illustrate this mix perfectly.
Okay, let's break down the 3 big ones, starting with the immediate cash generator, Imdeltra.
Right. So the Imdeltra deal was for a royalty from Beyond Medicines. It was $885 million upfront, with a total potential of $950 million. This is a big strategic bet on an Amgen commercial oncology asset.
And what's the rationale for spending almost $1 billion here?
It's highly de-risked, and it has incredibly strong efficacy data. Imdeltra is already approved for extensive stage small cell lung cancer, and it showed a 40% reduction in the risk of death versus standard chemo.
40% is a huge clinical benefit.
It's a game changer, and that efficacy translates to strong financial projections. Consensus sales are expected to hit around $2.7 billion by 2035, and RPRX expects a solid, low double-digit unlevered IRR on the deal. It's stable, immediate cash flow.
Okay, now the second deal, Amvuttra. This one brings them into the innovative RNAi space.
Right, they acquired a 1% royalty on Alnylam's Amvuttra from Blackstone for $310 million. It's strategic because it gives them diversified exposure to this cutting-edge RNA interference technology for ATTR amyloidosis. The royalty runs all the way through March 2035.
The sales projections for Amvuttra that I saw were just massive. Something like $8.4 billion by 2030. That seems very aggressive, doesn't it? Especially with potential competition.
It is aggressive, and the main risk is actually from Alnylam's own next-generation product, nucleosiran. But the huge projection just shows you how large the addressable market is. RPRX is confident that even with competition, their 1% slice is a good deal at $310 million. It shows they know how to price that market risk.
Okay, and finally the pipeline bet. Obexelimab. This is the definition of a high upside synthetic royalty.
Absolutely. This was a structured funding deal with Zenus Biopharma. RPRX provides up to $300 million for a 5.5% royalty, but the key is only $75 million of that was paid up front.
So they get late-stage pipeline exposure with very little initial cash outlay.
Exactly. The drug is targeting a rare autoimmune disorder called IgG4-RD with pivotal phase 3 data expected by the end of 2025.
And the real upside is if it succeeds in other indications, like MS.
Yes. It showed phenomenal phase 2 data in relapsing multiple sclerosis, a
Yeah.
95% relative reduction in new lesions versus placebo. I mean, that is a potential game changer in MS, and RPRX gets exposure to that massive upside for a relatively small upfront bet.
This blend of commercial and clinical assets really speaks to the portfolio's stability. They have royalties on more than 35 commercial products and 17 in development. That diversification is key.
But the truly extraordinary number, the one that should make the market really pause and question its assumptions, is their track record on those development stage investments.
The clinical trial world is notoriously risky. The industry average for a drug to go from start to finish is only about 9%.
Yet RPRX's development stage investments have a 95% hit rate by value from 2012 to 2022.
Wait, 95%?
Yeah.
That's almost unbelievable. How much of that is just luck versus their proprietary due diligence? Are they just waiting until phase 3 when most of the risk is gone?
That's a healthy skepticism, but the data is consistently strong. And no, it's not just luck. It's their expertise applied at the right time. Most of their bets are in phase 2 or phase 3, where the industry average is still only 59%. Their internal scientific team filters out the vast majority of risky candidates before they even start talking money.
One analyst called it an incredible slugging ratio. They don't just pick winners, they bet big on the ones that are going to be massive blockbusters.
That's the perfect way to put it. The buy value part is key. It means even if they strike out on a few small bets, their hit rate by count is 79%. The successful ones are so huge that they overwhelm any losses.
And they structure the deals to mitigate risk even further. Tell us about that Teva deal again.
The Teva deal for TEV-749 is just brilliant risk mitigation. The structure guarantees RPRX gets all of its initial investment back after approval. But here's the kicker. If the phase 3 data is positive, but Teva decides not to file the drug with the FDA for strategic reasons, RPRX immediately gets a 25% return on their money.
So they're protected against both clinical failure and a partner's change of heart.
It dramatically shifts the risk profile in their favor.
So beyond the current cash cows, the valuation really depends on future growth. What are the key catalysts we should be watching for over the next couple of years?
The pipeline is absolutely packed with pivotal readouts that could significantly re-rate the value of their development portfolio. The most immediate catalysts are in Q4 2025 and into 2026.
What are the highlights?
First, we're expecting those phase 3 results for obexelimab and IgG4-RD by year-end. Second, also in Q4, we should see crucial phase 3 results for deucrictibant, which is a promising on-demand treatment for HAE attacks.
And what about in oncology?
Following very positive early data, Revolution Medicines is starting a phase 3 study for daraxonrasib in first-line pancreatic cancer in Q4. This is a big one. The asset got an FDA Commissioner's National Priority Voucher, which is a huge sign of regulatory support and will speed up its review.
So that pulls potential cash flow forward significantly.
It does, and you can't forget the steady growth from the established products like Xtandi and Trelegy, or label expansions for drugs like Tremfya, which is getting approved for ulcerative colitis and Crohn's disease. That opens up vast new markets for their existing royalty stream.
Okay, we've spent a lot of time on the quality and growth of the platform. We have to shift now to the fundamental risks, because these risks are exactly why the market is discounting this stock, despite the stellar performance.
Right. The primary risk isn't manufacturing, it isn't sales. That's all in the partners. The primary risk is entirely legal and technical. It's time.
Intellectual property duration.
That's it. IP duration is the single most important determinant of valuation and cash flow longevity for RPRX. These are finite assets. The average duration of their current portfolio is about 13 years before generics start to erode sales.
So accurately modeling that duration has to be this enormous technical challenge.
It's the core function of their specialized team. It involves analyzing patent law, factoring in term extensions, assessing regulatory exclusivities in the US, Europe, Asia, and then projecting the exact entry time of generics.
And what happens if they get that modeling wrong? If a patent gets invalidated and the duration is suddenly cut short?
The consequences are severe and immediate. An unexpected shortening of a royalty term forces a mandatory reduction in the asset's effective interest rate, which means a decline in future reported income. Or, worst case, a massive permanent impairment charge against the asset's book value. It hits the balance sheet hard.
And this risk is so pervasive that even a contractually perpetual royalty still has a finite life in their models.
Exactly. The Trek royalty, part of that CF franchise, is technically perpetual. But RPRX still estimates its effective cash flow end date is between 2039 and 2041. Why?
Because that's when the patents are expected to expire and generics will enter the market.
Right. The market views these as having a defined life cycle, period.
We established that RPRX has this incredibly stable 81% PCF margin, yet the stock itself is surprisingly volatile. How can the stock of such a stable cash machine be as volatile as a growth tech stock?
It's a huge contradiction, isn't it? The 30-day implied volatility is at 32.4, which is in the 94th percentile for the last year. For a company defined by predictable cash generation, that level of volatility is a clear signal of market concern.
What is the market signaling with that volatility?
The market is assigning a huge risk premium specifically to the binary high-impact outcomes of IP litigation. I mean, a quarterly earnings miss is manageable, but the sudden, unexpected invalidation of a multi-billion-dollar patent on the CF franchise, that could wipe out years of projected cash flow in a single day.
So the volatility isn't about the current cash flow. It's about the uncertain duration of the future cash flow.
Exactly. It's that potential for a massive binary black swan event.
And to fund that ambitious capital deployment target, RPRX relies heavily on leverage. We have to look at their debt.
We do. As of the end of Q3 2025, their total debt was $9.2 billion. That puts their net leverage at 2.9 times adjusted EBITDA, or 3.2 times total leverage.
But their cost of that debt is a major competitive advantage.
Right. It's a huge advantage. Their weighted average cost of debt for their unsecured notes is only 3.75%.
That is incredibly cheap capital. It lets them outbid competitors for assets because their borrowing costs are so much lower.
Absolutely. But that leverage also exposes them to rising interest rates. Total interest paid is expected to be about $275 million in 2025, but that's projected to jump significantly to between $350 and $360 million in 2026.
Wow, why the big jump of almost $90 million next year?
It's the full year impact of the $2 billion in new notes they just issued in September to fund these recent acquisitions. It just highlights how sensitive their bottom line, their PCF, is to future interest rates. They're accepting more interest rate risk in exchange for that massive deal flow.
Okay, this brings us to the ultimate question, the paradox that is holding this stock back. If RPRX is a high-growth, market-dominant leader with an 81% cash margin, why is it trading at such a discount?
Well, we've established that the PE ratio of 22 is useless because of the GAAP amortization. To get a true picture, you have to look at price to free cash flow.
And the PFCF is a shockingly low 8.0. I mean, that just seems impossibly cheap for a company growing at 15%.
It is a profound outlier. The U.S. pharmaceutical sector median PFCF is 20.9. RPRX trades at this massive discount, ranking at the 17th percentile for value based on its ability to convert revenue into cash.
So why the skepticism? What is the market so afraid of?
The analysis points to two deep-seated fears. First, the market might doubt their ability to maintain that stellar 15.7% ROIC as they deploy another $10 to $12 billion. Maybe they think they'll run out of good deals.
And
Second, and this is the big one, the market fears that the IP duration risk we just detailed is going to severely impact long-term cash generation. This triggers the core terminal value debate.
let's define the bear case on terminal value again. This is the argument that's keeping the multiple at 8 times cash flow.
The bear case is simple. Drug patents expire. Since the underlying assets have a finite life, RPRX cannot generate value passively into perpetuity. Therefore, you cannot assign a traditional high-growth perpetual terminal value to the business.
But that logic completely ignores the ongoing operational platform and management skill, doesn't it?
It does, and this is the strong counter-argument. You have to ask, why do publicly traded investment managers like Blackstone or KKR trade at 20 to 30 times PE? Their assets, the companies they buy, also have a finite duration. They rely entirely on management's active investment skill to keep finding new deals.
So if the market values Blackstone based on the expectation that its management will always be able to raise a new fund and find new deals, why isn't RPRX valued the same way?
RPRX argues that its proprietary scientific expertise, its dominant market share, and its access to capital create a continuously compounding, self-renewing machine. The platform is the asset.
But the market sees it differently.
The market continues to view it as an expiring bond portfolio, not a perpetual asset manager, and they discount it heavily for that perceived risk.
Okay, let's run a stress test. Our sources use some extremely punitive assumptions. What if we assume RPRX stopped all new investment today and got 0 successful pipeline approvals in the future? What's the value of just the current approved assets?
Even under those incredibly harsh conditions where the company effectively stops growing, the calculated net present value of the existing royalties still comes out to $13.1 billion.
And the recent market cap was around $11.7 billion.
So even in that doomsday scenario, it suggests a moderate 11% upside. The stock is priced for something far worse than even the most skeptical bear case implies.
What if we try to normalize their earnings to account for that churn, viewing them as a going concern?
That's the idea of maintenance capex. The theoretical investment they need just to keep cash flows flat as old royalties expire, that's estimated to be about 41% of their revenue.
The huge operational haircut.
A massive haircut. But even after applying that theoretical 41% reduction to their earnings, RPRX still trades at a normalized PE of only 12 times. It's still a deep, deep discount compared to big pharma or the financial mega funds.
So where does that leave us with price targets?
When you put it all together, the cash flow, the hit rate, the dominance, offset by the IP risk, the analyst consensus is a moderate buy with an average price target around $48.50.
But the relative valuation analysis, which applies peer multiples to their normalized cash flow, suggests a much higher value.
It does, a base case value closer to $58.05. That $58 figure implies that RPRX may be fundamentally undervalued by up to 30% relative to peers with similar growth and margin profiles.
And the path to closing that 30% gap is just continued execution.
Consistent execution on the capital deployment plan, successful launches of new assets like Imdeltra, and a steady stream of positive clinical data that just keeps validating their expertise.
This has been a deeply insightful look into a truly unique business. Royalty Pharma presents this remarkably resilient defensive model with that exceptional cash conversion, that 81% PCF margin backed by double-digit growth, and an almost unbelievable track record of picking winners. That 95% hit rate by value is just astounding.
The investment case really boils down to a definitional debate that the market hasn't resolved yet. Should RPRX be valued like a fixed-duration bond fund, where you discount every asset for its eventual expiration? Or should it be valued like a continuously compounding asset manager, where the management's proven expertise is the real perpetual asset?
And the market is clearly valuing it closer to the depreciating bond fund model. That's where the PFCF discount comes from.
That's the crux of it. Management argues the platform is the value. The burden of proof is on them to keep demonstrating that their strong ROIC and that phenomenal 95% slugging ratio are sufficient to overcome this perceived terminal value problem.
Which leaves us with the final provocative question for you, the learner. Given that the market is assigning RPRX a high-risk premium due to the finite nature of patent life, is the company's demonstrated repeatable expertise in generating high returns and maintaining that 95% success rate sufficient evidence to overcome the perceived terminal value issue and unlock that implied 30% valuation discount?